Good morning and good afternoon, everyone, and welcome to the JavaCard Forum webinar series. Today, it is our fifth webinar in this year 2024 webinar series. My name is Clemens Seemüller. I am member of the business committee in the JavaCard Forum. Today's webinar is a talk on digital cash, secure wallets for online and offline payments, given by Lars Hupel of Giesecke+Devrient. Lars is a CBDC evangelist at Giesecke+Devrient with a particular interest in security, offline payments, and financial inclusion. An engineer at heart, Lars is working to bring modern financial services to people. Lars holds a PhD degree from TU München in the field of logic and verification. When we think of electronic payments, there are a lot of different interpretations. Bank cards, credit cards, mobile money, QR codes, and more. Lately, many central banks, including the European Central Bank, have started investigating or piloting digital currencies, also called CBDC, to introduce yet another way to pay electronically. The wish list for CBDC is long. It should support online and offline payments, work as usual at the point of sale, be accessible to users without bank accounts. At the center of these design discussions are wallets, powered by secure hardware. Lars gives an overview over the current CBDC ecosystem, explains some novel techniques that could help to implement wallets at scale, and give a perspective regarding standardization. You will be able to post your questions during the presentation in the chat or directly after the presentation, where we will unmute the microphones. This presentation is recorded and will be available later on our YouTube channel and the JavaCard Forum website. Without any further delay, please welcome Lars. Lars, the screen is yours.
Thank you very much, Clemens, for this introduction, and also welcome from my side. So Clemens already told you the title of this talk, Digital Cash, Secure Wallets for Online and Offline Payments. And I will admit right away that I am slightly biased towards offline payments just because it's much more interesting than online payments, at least to me. But I will obviously discuss both of those in this presentation. Now to start, I have brought you a small puzzle to get the presentation started. There's 4 pictures on the slide. We have shells in the top left, we have salt in the bottom left, then we have gold at the top right, and banknotes at the bottom right. And the puzzle is now, what do these 4 pictures have in common? And the answer is they all served or continue to serve as money in our society. Now, obviously, we have moved on from the shells and from the salt, but what I would wager that banknotes are still very much liked, especially in Germany, which, as you may know, is a very cash-liking country, and some people also still like gold as a store of value. Now, this talk is going to be about a 5th picture that you don't see here on the slide because it's very hard to actually depict in this form, which is digital cash. So let's try to set the scene for this presentation. Digital cash. I want to answer a few questions. First question: what is it, digital cash? Second, how do the wallets work? As Clemens already hinted at in the abstract of the presentation. Where is it used? And finally, how can I pay? Now, before I start with the actual content, I just want to point out that with digital cash, I do not mean cryptocurrencies here. So this is not a talk about Bitcoin or Ethereum or Tether or any of these things. This is really a talk about cash as in banknotes, as in central bank money. Now, another word that we could use for digital cash would be central bank digital currency, or CBDC for short. And I think the best way to explain it is as the intersection of 2 existing forms of money. So on the left side here, we have banknotes, which are issued by the central bank. And as of today, banknotes are the only way that I, as a consumer, can get my hands on central bank money. Everything else that I do today is private money. So if I have a credit card and so on, that's all private money. So that would be the right side of this Venn diagram. Everything that I have in forms of digital money right now is either bank deposits or e-money or credit cards or something like that. So we have public money on the left side, we have private money on the right side, and they all have some characteristics we like. So now we're trying to combine those advantages and have a CBDC, central bank digital currency, which is money that's issued by the central bank directly to users. It doesn't mean that the user must now have somehow a bank account at the central bank. So I'm not going to call Christine Lagarde at the ECB and ask for a bank account. That's not what's happening here. There is still place for intermediaries, but I will talk about this in a moment. Now, why am I talking to you about CBDC? Well, it's a hot topic in the community, with 94% of central banks worldwide actively engaged in CBDC work. And that's not our marketing numbers, that's actual numbers from the Bank for International Settlements, which you can imagine as the central bank of central banks in their last survey from 23 and 24. Now, of these 94%, 54% are developing proof of concept technology, and 31% are deploying pilot projects. And one of the important motivations of this is that in many countries, there are a lot of people, there's a large part of population that has no access to banking services. So there's a lot of people that have to rely on cash to do their business. And we want to bring digital financial services to those people. And now, if I say that, you might be thinking, well, this probably applies to developing countries, for example, some countries in Africa, but it's also the case in the European Union. So in the European Union, 13 million adults face financial exclusion. In the Nordic countries, this is a very low rate, but in some countries in Eastern Europe, the rate is somewhere around 20 to 30%. So it's a problem that applies to pretty much every country. And if you've been following the news, you might have also heard something from the European Central Bank. And just recently, just last week, the ECB published a second progress report on the digital euro preparation phase. So they are going full steam ahead with the digital euro, which would be the Eurozone's CBDC. Okay, now enough with the motivation. I want to talk to you about what it actually is, the CBDC. And I think the best way to explain that is to show you the different use cases that the central banks have in mind for CBDC. So let's take here a user. Any user could be a consumer, a citizen, tourist, kid, whatever, some person. And that person might have different wallets. So that person might have, for example, a typical card or smartwatch, smartphone, or maybe even a laptop to do their banking business. Now, there's different ways that this person could spend the money now. And I want to show you these three main use cases. So there's obviously a case for person-to-person payment. So I'm having dinner with a friend, and then the friend's paying for the dinner, and I want to pay them back. So that would be one option. Then I could also be using this money for online shopping, or I could be using this money for point of sale. Now, there's a very subtle point on this slide, which is these Wi-Fi icons. So most of these use cases are supposed to work both in online settings and also in offline settings, except for online shopping, of course, for which you need to be online. Now, what does it mean? Let's say I'm hiking in the Bavarian mountains, and the cell phone reception is very bad, but I still want to, go to a cottage and maybe have some lunch there, and I want to pay. Right. So right now, the only way I can do this really is to use cash reliably. So I can give that cash to a friend, I can give that cash to the point of sale, but really there's no online way of settling that right now. And CBDC is supposed to fix that. So we're supposed to be able to use this money in any scenario under any circumstances. Now you might be wondering, well, I mean, with credit cards, I can pay offline today already. Like I can make an offline payment and it's going to be settled later. So the merchant just has to wait for a few days and then the money will also arrive in their bank account. But the key point is that it takes a few days. So you do not have instant settlement with credit card payments or other kind of bank card payments right now. And the key idea for CBDC is that it should be consecutively offline. What I mean with that is I can give this money to a friend, and then that friend can immediately turn around and give that money to someone else. And obviously not just a friend or a merchant or something like that. And the way I like to illustrate this is with taxi drivers. So no matter in which country you are, if you're in Germany or some other country, last year I was traveling through Hong Kong, and I was surprised to find there that also the taxi drivers there prefer to take cash. And it's not because they want to do tax fraud. I mean, all of them are running a meter in their cab, so they can't do any tax fraud with that. But they need the money that I just give them to pay for their fuel. So they can't just wait for 3 days that the money arrives in their bank account because they need to refuel their car today. So cash is the only way that they can do that as of now because it's instant and it's offline capable. With CBDC, we would fix that. With CBDC, we would be able to pay online, offline, and it's instantly settled. So there's no need to wait for a few days until the money arrives. Okay, so much for what it is. And I will get a bit more technical now because, of course, you're probably interested in how can we implement this really. And the way we propose doing that is by modeling the digital cash after physical cash. Now, as you might know, Giesecke+Devrient, my employer, also prints banknotes and is quite a big business, of course. And a banknote is a really nice payment instrument because it's a physical object. So it's a physical object that has some security features, for example, a watermark or a hologram, and I can give this physical object to someone else, and that other person can then inspect it, and once they accept it, the payment is settled. So there's really nothing else that happens afterwards. There's no clearing or settlement or anything afterwards. I give that object to someone else, and then the payment's done. So this is what we call a bearer instrument, because a bearer instrument means if I bear it, I have the money, I can pay, it's mine, and I can give it to someone else. So that's really cool. And it's also very different from the accounting model that we have in online banking, for example. If you have a bank account somewhere, then that's not what happens. It's not a bearer instrument. A bank account is like a balance that you have, and cash is not balance. It's a physical object that has a value. Now, what we propose is to model the digital cash just like that. So on the right half of the slide, you see this digital object, which is here an artist's impression of a digital object. And obviously it needs to have some cryptographic elements. So here, just as an example, I put here a private public key pair, and that private public key pair would have an associated value. So for example, this is what we could call a token that is worth 20 euros and is a private public key pair. And I could move that private public key pair to someone else, and then that would be the payment. Now the question is, of course, where is this token stored and how is this token transferred? So now is where I get a bit to the wallets. On this slide, there's a whole bunch of devices and gadgets, and what they have in common is that they are capable of storing this digital cash, of storing these tokens. And if you squint a little, you will find that these are exactly the same form factors as we have, for example, for credit cards today. And what they all have in common is that they have secure elements. They contain secure elements that are capable of storing cryptographic secrets without the risk of exfiltrating them. So just as an example, we have, of course, here smartphones, we have wristbands, we have the traditional card formats, and we also have point of sales terminals, because point of sales terminals, if they want to, stay offline, if I'm in the Bavarian Mountains, then obviously they also need to store the digital cash on there. So the point of sales terminals very often also have this secure hardware, although as a caveat, most of them don't actually have the standardized secure elements. So we can't actually run a Java card OS on these devices, but on most of the others, we have some form of that. But obviously the most interesting to most people that are probably listening to this presentation would be the smartphone, right? So everyone here probably has a smartphone, and they would also be interested in keep paying with their smartphone. Maybe you're already using Apple Pay or Google Pay, and then ideally the user experience of paying with digital cash should be the same. Now, here's a question to you. Where is the money? And this is actually a very important question, because if you're around in the payment ecosystem, you will have heard the term wallet before. Unfortunately, if you ask two people what a wallet means, you'll get 5 answers. So there's a lot of different definitions of what a wallet is there. So I want to, make clear distinction where the money actually is. And if the money is stored somewhere on a bank account or somewhere on the server side, like for example PayPal, that's what we would call a custodial wallet. So it's custodial because someone else has a custody of that money. If you have the PayPal app on your phone and it has a balance of 20 euros and you lose your phone, you can just get a new phone and the 20 euro will still be there. So that's a sign that the money is not actually stored physically on the phone. What's stored on the phone is just the credential. So the money is elsewhere. On the right-hand side, when we actually put the money on the device, the digital cash, that's what we would call a bearer wallet. And if you just remember from 10 minutes ago, I talked about cash as a bearer instrument. This is the same thing. So we have now the money actually stored physically on the device. And one analogy I like to make is with streaming. So when you have these streaming apps, you can download a copy or you can download some content on your device, and then it's actually available on the device for offline viewing, for offline listening, and it would be the same for the digital cash. So you would kind of download some part of your money, and then you have it available on your phone or on the other device, and you can use it to make payments even if you're not connected. Obviously, that means that if you lose the device, your money will also be gone. So that's the same thing as for cash. If you have cash in your wallet and you lose the wallet, your cash is gone. Now, this is also a topic that's somehow related to privacy. Is someone else able to somehow restore that money? But that would be an entire other talk. So I'm going to exclude that discussion here. Let's just assume that it behaves like physical cash. Right, now let's get even more technical. I already hinted at it, that all of these form factors of the wallets, they need to have some kind of secure hardware. What does this look like concretely? So any hardware wallet that we're proposing needs to have these elements. So of course, a secure element is required. So we have, for example, an embedded secure element or a SIM card or some kind of external secure element. Maybe if you have a dedicated card, you can also hold the card to the phone and then the money would be stored on that dedicated card. You obviously need some form of communication channels, for example, NFC or Bluetooth Low Energy. NFC, I think, would be the most popular one because that's also how it works today. You take your phone and you touch it to a point of sales terminal. And then the payment gets done via NFC. The challenge with those channels is that they are all completely untrusted. So NFC is not encrypted, and you don't want to have a man-in-the-middle attack here that somehow could exfiltrate the cash while it's being handed over to a merchant. And thirdly, you would also need some kind of companion app, right? So you need to have an app on the phone that tells you this is how much money you have, and to do some kind of verification, for example, Face ID if you do CDCVM, or a PIN verification or something like that. Now, the companion app doesn't need to run specifically on the customer device. The app would also run on the point of sales terminal so that you can make a payment from a card to a point of sales terminal, for example, if someone does not have a smartphone. Right. Before I move on to the next slide, I want to just zoom in on the secure element again, because on this slide I just write ESE/eSIM/SIM, but there's a lot of detail hidden in that parentheses. If you've watched the talk from my colleague Karl Egloff, I think 3 years ago from the Java Card Forum, he gave a talk called Virtualizing Secure Elements, where he goes into excruciating detail. On a modern smartphone, there are many secure elements. There are many ways to put applets into those secure elements. So he described, for example, how to put these applets on an eSIM. And there's many different ways of doing that. But yeah, I don't have the time to go into this detail here. If you want, you can ask a question afterwards, or you can also watch Karl Egloff's talk, which is very good. I learned a lot from him. Okay, so moving on now, I want to show you a particular payment. So we just like to take a look at how a payment works from end to end, basically. So let's start with a payer and a payee. Now, to make it slightly more interesting, as a payer, I chose a smartphone, and as a payee, I chose a smart card. And if you want a scenario for that, just imagine a parent giving pocket money to a child. And maybe the child is not old enough to have a smartphone yet, but the parent has a smartphone. So the parent would have some money maybe in a bank account or already has money downloaded to the phone. And now the kid comes and says, can I have 20 euros as pocket money? So the parent wants to give 20 euros to the child. What the parent would now do physically is hold the card at the back of the phone so that they can create an NFC connection between those two devices. And now the data somehow must flow between one device and the other device. And I want to show you what data that is, and also talk a little bit about privacy of this payment. Now, this 20 euro token that's now being moved, I already told you about, it's a private public key pair. And the 20 euro token would be stored in the parent's device. So for example, in the eSIM or in the embedded secure element. And now this is supposed to be moved from A to B. And note that I say moved and not copied. Obviously, you can't copy this because that would be double spending. And that's why we use secure hardware to ensure that the money is actually moved and not copied. Now, this 20 euro has an amount, 20 euro, of course, but it also has a public key and also a private key, of course, attached to it. And that would be what's being moved here from A to B. And one thing that you need to make sure, for example, is that this transfer is idempotent. So, for example, if the NFC connection fails for whatever reason, maybe because you didn't hold the card right, or I don't know, power is out or something like that, then you need to be able to repeat that, and you need to make sure that the 20 euro doesn't just get stuck in the middle, because if you remember from earlier, there's no clearing, there's no settlement, so you can't have the credit card network swooping in and somehow rolling back the transaction. So it's like physical cash. You need to make sure that the money does not get lost in translation. Okay, what else? Obviously, these devices have some kind of identification. So there's some kind of wallet ID attached to them, and they would also record the time and date of when that transaction is happening. But that is, to be very clear, that's just metadata. And I will talk about this in a moment. So let's zoom in slightly more how this money is now being transmitted. This token that we have here, the 20 euro, it's physically moved across this NFC, for example, but on top of that NFC channel, we built an end-to-end encrypted channel so that we can't have any kind of man in the middle in there. And that would be based on existing standards like SCP. Now, I forgot which number, I think it was SCP 11 that we're using here. Now, what's really interesting about this protocol is that we actually have a mutual authentication here. So the smartphone and the card would first negotiate this encrypted channel by presenting each other certificates. So each wallet has an individual certificate, and that's how you can establish an end-to-end encrypted channel. And you can't have any man in the middle there, because the man in the middle, an attacker, would not have this wallet certificate. And ultimately, those wallet certificates are part of a PKI, a public key infrastructure, and they all coming from the central bank. So the central bank has control over the issuance of wallets, which means that there are no illegitimate wallets that could be circulating. So each wallet individually gets signed by an intermediary, and that intermediary gets signed by a central bank. We have written a research paper on this. If you're more interested in that, please ask a question afterwards, and we'll be happy to elaborate. But the general idea is both wallets first establish an end-to-end encrypted communication channel. And this metadata that is being created is kept in both wallets. And the key thing is, this metadata is kind of like your bank statement. So you can open your app, your CBDC app on your phone, and you see, oh, I did this at a particular point in time. At 10:15 on the Friday, I paid this amount of money to someone. This data is not required to do some kind of verification of the payment. It's just for your bank statement. And if you want, you can share it, for example, with your bank. If you actually have a custodial wallet, then this could be used for analysis or whatever. But the point is, this is your data. It's not required for any later settlement step, because there's no later settlement step. This wallet ID that I have here also is a pseudonym. So it's connected to the wallet certificate, and the assignment between the wallet ID or the wallet certificate and the actual identity is known by your bank. So if you go to a bank and ask for a wallet, then they would know that, because they have to do KYC and all of these things, but it's not something that is globally known. So the central bank has no global register of, wallet ID 123 belongs to Lars Hupel, and Lars paid this amount of money. So this is really important here, that this is not information that's necessary for the actual payment. And this is also the difference to credit card payments, for example, because for credit card payments, you're using these account numbers basically for actually validating the payment. This is not necessary in this setup. You only need the token that you give from A to B. Now, this token again has the public key, but there's no metadata attached to the token, and you need this for an integrity check. So let's say there's money circulating, the digital cash is circulating in the economy, and just like a banknote, at some point you want to know if it's actually a valid banknote or if it might be counterfeit, and then you can use that public key to check that with the central bank, because the central bank is the issuer of your tokens. Central bank issues these tokens into circulation, just like they issue banknotes in circulation. And obviously they have a list of all the public keys of the tokens that are in circulation. They don't know who currently owns it. They don't know what the history of that token is necessarily. But you can ask them, please tell me if this is a valid token. So this is what they can do. Okay, now I know this is a lot, so maybe let's take a step back and look at the bigger picture. Again, the analogy would be cash here. And what's really nice about cash is that all of these things, all of these steps with the metadata and the token is being handed over, it kind of happens implicitly, right? Any child can learn it. You can give a banknote to someone else, and then they can look at the banknote and like check if it somehow feels right, if it has a watermark and all of these things. And it'll be it'll be done. There's really nothing complicated there. And what's really happening here in these cash payments is that you have a payer and a payee identity, and you have this identity by two people looking each other in the face, right? I'm at the point of sale, and I know this is the merchant, and I'm giving them the money right now, and there's no man in the middle that just takes the money, because I'm looking that person in the eyes. There's also this authenticity question where you can just look at the banknote, look and feel and so on. And ownership is kind of trivial. Like everyone has a wallet, and that wallet could just be a pocket in your pants, right? So it's really not that hard to keep cash. And this is the sort of things that we also need to emulate for the digital money. But there's even more things that we need to do for the digital money, not just identity, authenticity, and ownership, but also, for example, something like non-repudiation, right? So you want to be able to prove that you've actually paid, right? So you don't want to have a situation where you go to the merchant and you pay with your wallet, and your wallet says you have paid, and the merchant says, actually, I don't think you have paid. Please pay me again, because I don't see it somehow. So you need to be able to prove that this payment has actually happened. You also need to prevent double spending. So you don't want to be in a situation where the banknote, the digital banknote, can somehow be cloned. And also, you don't want tracing. So you don't want the central bank to be able to look at how Lars Hupel specifically has used this money in the past. And there are ways to control for these security requirements. We have to work slightly harder than with cash, because I mentioned, for example, the identity aspect with cash is trivial. I just looked that person in the eye. For digital money, we have to use these certificates. Other things are easier in the digital world than in the physical world. I can tell you that the colleagues from the banknote department at Giesecke+Devrient, they work very hard on preventing double spending and authenticity and so on. So some things are harder, some things are easier. The way that we do this, or the way that we explain how we do this generally, is with this three-layered security concept. So we have this token here in the center. How do you protect this token? Well, first of all, strong hardware security. And I mean, I'm preaching to the choir here. I'm preaching to the Java Card forum. Obviously, we are into secure elements. We like secure elements, so that's why we choose secure elements to store these tokens, because it is extremely hard to actually extract a token from the secure element, or to clone the secure element, or to reset the secure element. All of these attacks are just extremely hard if you're building on the hardware secure elements. The second line of defense would be secure payment protocols and channels. One example that I mentioned is that NFC is not encrypted. So we're putting these on top of the tokens that we store in the secure elements. We also store certificates, and we can use those certificates to establish end-to-end encrypted channels, which is something that does not happen for credit card payments, for example. Credit card payments are that the protocols often just use HMACs or signatures. We actually here have these full end-to-end encrypted channels to make sure that there's no man in the middle. And then the third line of defense would be the central bank. As I've mentioned, the central bank has a list of all the tokens that are in circulation. So if I do some offline payments and then the merchant goes online at the end of the day, maybe because they have a very expensive dial-up connection, they only dial up once a day, then this money can still be audited and can be checked that it's actually valid. And should there be any foul play, it would be this at this point in time when it would be detected. Now, this is all the technical stuff that's really specific to digital money and to putting those wallets on devices. But there's also an interesting overlap between the physical cash, the banknote, and the digital cash, which is the fact that we can try to issue wallets that have some of the features also of banknotes. So this is especially relevant for countries where a lot of people don't have smartphones, or where some people prefer to have dedicated cards and not put everything on their smartphone. Germany would be one example. I know a lot of people in Germany who could use Apple Pay and Google Pay, but they choose to use a dedicated card because what if they lose their phone, or what if their phone breaks? So the dedicated cards would be preferred there. And this is from 2 pilot projects that we did actually. So I can talk about this more in a minute. The idea that we don't just put like the technical, like the applets and all of the stuff, the secure elements into those wallets, but we also equip those wallets with physical security features, for example, a hologram, or some kind of features that they know from banknotes. On the right side of this slide, you see a banknote from Standard Chartered Bank in Hong Kong. And for that pilot project, we sort of try to emulate the design, so that if people have this card, it doesn't feel like a credit card. It feels like really cash. It feels like something that their central bank, or in the case of Hong Kong, Standard Chartered, issued to them. And it has the same properties as the physical cash. So I find that to be very exciting. Obviously, this does not apply to people having smartphone-based wallets, but I think in terms of financial education, in terms of like explaining to people what that is, it is very valuable. Okay, I promised to talk to you about a few of the pilot projects we did, and I promise you that this is not going to be a marketing talk, so just bear with me for a moment, because there's some technically interesting things that we did here. So maybe let's zoom in on the project in Ghana that we had. One of the cool things about CBDC is that since it's issued by the central bank directly, it's also a liability of the central bank. Now, what do I mean here? Any sort of private money is a liability towards the issuer. So for example, if I have a bank account at a particular bank, that's their liability. So if that bank goes bankrupt, I have a problem because they are gone. It's not public money, it's not like cash. If the bank goes bankrupt, my deposit account is basically gone. This is where a lot of problems arise in banking. If I make a payment from bank A to bank B, then they have to turn this liability of bank A into liability of bank B, and that's where a lot of friction comes into play. A lot of fees and a lot of delays in the settlement is caused by the fact that it's private money. With CBDC, this is not a problem. With CBDC, I have this token, I can pass this token from A to B, and it's the liability of the central bank. So I don't need to wait, I don't need to pay any fee for that. It just works. I just give it from A to B. And a consequence of this is that not just banks can handle CBDC. There are also some non-banks, some non-traditional financial institutions that could handle CBDC. And in this example, you see the Vodafone app in Ghana. And they already operate something that's called mobile money. So you can send each other basically prepaid balances. And still, the settlement happens only once a day. So there's still a lot of fees for the operator, and there's some kind of delays. And they can make this more efficient by using CBDC. So that's what they did. This is the actual Vodafone app in Ghana, and they integrated our solution. And now, at the time of the pilot, as a Vodafone customer, you could access a CBDC wallet directly through the Vodafone app. So I found that to be pretty cool, because now suddenly you're being banked not by a bank, but by a mobile network operator. So I find that pretty fascinating. The other example that I can show you here would be from Hong Kong pilot. So you see here 2 different form factors in action. You have a phone with the wallet app on it, and you have a dedicated smart card. And you can use the smart card to, you can use the smartphone to top up the smart card, for example. But you can also pay using QR codes. So this is once again a scene from Hong Kong. So the CBDC doesn't really matter how it's being transferred. Is it being transferred over NFC? Is it being transferred over Wi-Fi, over 4G? Doesn't really matter, as long as you have a communication channel, and maybe you establish that communication channel just via QR code. So it's very flexible in that regard. And by the way, this is also how the European Central Bank envisions the digital euro. You have the wallet, and it doesn't really matter in which situation you are, you should just be able to pay. That's the general idea. Okay, I'm getting to the close of the presentation, but there's one topic I haven't really talked about a lot, which is how would the payments actually work in practice. So just some more technical details. If I'm at the merchant at the point of sale, I want to actually do something. How is the how does the actual mechanic? How do the actual mechanics work? Now, we built a prototype for merchant payments. We built that prototype in 2021, and it was basically this 3D printed device with, I believe there was a Raspberry Pi in it. So this was a prototype device where you have two cards, one customer card and one merchant card, and then the payment is actually done between two cards, which is also quite fascinating if you think about it. Normally, the card is for the customer and the merchant does not have a card, but here you actually transfer the money from one card to the other card. Why did we do this? Well, this was for the pilot project in Ghana, and a lot of merchants in Ghana don't have POS terminals. So you have to give them something, and many of them don't even have smartphones. So you need to give them somehow a device that can accept payments between two people. And here, the only white person in this picture would be my colleague Daniel, who co-developed this payment device, and he's giving here a course in how it works. It has a battery in it, and you can do these payments between different cards. So this worked quite well in Ghana, in very rural areas, again where the infrastructure is not so strong. But obviously in Europe, for example, most merchants would have a payment terminal, an existing payment terminal. So we need to think about how to integrate CBDC payments into these existing terminals. And at this point in time, I have bad news for you, because the Bank of England, they are also investigating CBDC, the digital pound. They did a proof of concept, and they tried to figure out how can we do online and offline payments with CBDC, with digital cash, on those existing POS terminals. And here's what they found. I'll give you a few seconds to read this excerpt. Okay, so why is this bad news? Because everyone uses EMV standards for payments. Every existing credit card scheme and many domestic card schemes use EMV. And what Bank of England found is that EMV is not appropriate for storing offline money on the cards or on the devices. And the reason is quite simple, because EMV was never designed to do peer-to-peer payments. And what digital cash is, it's peer-to-peer payments, just in different scenarios. Peer-to-peer could be person to person. It could also be person to merchant, could also be a merchant to person for refund. So it's basically just different types of peer-to-peer payments, and EMV was never designed for that. So we need new standards. We can reuse some parts of EMV, but we also need to build new kernels on those POS terminals in order to accept offline payments. For online payments, the story is different. For online payments, I'm sure there's a way to integrate it with EMV. It's more of a kind of an A2A, account-to-account payment there. But especially for offline, we need to think a bit harder. Now, the cool thing is that this is not a new issue. POS terminals have always had the problem of accepting new and more modern payment schemes. So this is why they support application selection. If you have a customer device, a merchant terminal, they both have lists of supported payment schemes. So they have these application IDs, and they somehow negotiate what payment scheme they would like to do. So as a user, I tap, and then there's first an application selection happening. Now the question is, let's say I have a wallet on my phone, and that wallet has offline CBDC on it. It has maybe a credit card on it. It has a domestic card scheme on it. How do we do the selection? I don't think there's any clear answer to this yet. Some people suggest that there should be a prioritization that's handled by the terminal. So for example, if the terminal detects that it's offline, it will say, I want offline CBDC. And if the phone supports it, then that's what's happening. But there could also be customer preferences. But all we know is that offline CBDC and also online CBDC will have dedicated application IDs so that you can clearly distinguish this in a payment process. Now let's compare that to the traditional user journey when you have a traditional payment card. This is very simplified. So please, if you're working in a PSP, if you're working for a card scheme, please, I know this is very simplified. It's a lot more complicated than that, but just for the sake of this example, just bear with me here for a moment. So the customer comes and presents a card, and then there's the application selection happening already today. And in some countries, this actually is a two-step process. If you're paying with a domestic card in Italy and you hold your domestic card to a merchant terminal, you tap once, and then we'll ask you, do you want to pay with the domestic scheme or do you want to pay with Visa or MasterCard? And then you tap again. So, this is already, many countries already have their established procedures for that. And then once the customer terminal have negotiated that, there's some kind of online payment happening. The terminal talks to the acquiring bank, and then via the card network, they're talking with the issuing bank, and there's some kind of clearing and settlement happening afterwards. So this is how a traditional user journey works. Now, the offline user journey is interesting because there's no card network or anything involved. Well, let's start with the customer terminal. They will also do the application selection, and now let's assume they've settled on using offline CBDC for this payment. Then the funds transfer would happen directly between customer device and terminal. And the interesting point is, that's where the payment is done. The customer transfers the tokens to the terminal, and terminal now has the money. So in principle, the slide could end here, right? But at some point, the merchant wants to redeem that money. The merchant wants to use that money for something else. So the merchant would go online and then, for example, ask for the money to be changed for deposits or whatever else the merchant wants to do with the money. But this happens after the customer has walked out of the building. So the payment has already happened in step 3. Step 4 is now something that the merchant can do at their own discretion. Now you might be wondering, where's the issuing bank in this scenario? The issuing bank is not really involved here at all, except for step 0. So obviously the customer has to top up the wallet before. So the user needs to get the money from somewhere, and then the transfer happens directly between customer and merchant, and there's no communication here at all between issuing bank and acquiring bank. Okay, so to summarize what I've just told you about, I have a picture here, which is kind of a joke that I put into this presentation. And this is a picture from one of my colleagues who went to Thailand, where we also had a pilot project. And I think this picture is from a Starbucks. And if you can count, I think there's 5 different POS terminals here. And some of those POS terminals are for domestic card schemes. Some of them are for international card schemes. Some of them show QR codes. It's kind of a mess. I was in Indonesia just last month, and I was at a supermarket, like a big chain supermarket, and each cashier had 7 POS terminals, which is clearly ludicrous. But what I'm trying to tell you here is that there's a better way. So we can introduce online and offline CBDC without giving them even more POS devices. So we can put that onto those existing POS devices, and the formula is quite simple. We start with the application selection, just as EMV specifies, so we can reuse that part. We can do the offline transfer of funds, and then at a later point, we can do the reconciliation depending on whether or not the merchant has connectivity at hand. Now, I'm now showing you the second to last slide. CBDC is a really emerging topic, and a lot of the questions that you may have might not have answers, but I still encourage you to ask all the questions that you may have. And it's really a way for us to have a clean slate in payments. There's a lot more efficiencies that can be gained because you have this direct peer-to-peer payment and because you also have this offline payment. So there's a bunch of scenarios that digital cash could be used for that I can't even think of right now. Maybe in 5 years, there will be new and exciting use cases cropping up because of these characteristics of CBDC. There's one thing that's also being worked on kind of in parallel to these technical streams that's unfortunately also not really clear yet, not really finished yet. And this is the topic of standardization. All of the existing card schemes, they use existing standards like EMV or global platform or all of these things. For CBDC, this is extremely unclear. For example, it's unclear if the digital euro will work in exactly the same way as the digital pound. The answer is probably no, they will probably work in different ways. There are some standardization efforts going on right now. I just brought here 2 examples of standardization projects. The first example would be from ISO. So this is the ISO CD 13133, which has just now completed the CD belt. So it's, I think in the next meeting, we will be just
So obviously we lost Lars. I at least on my end, I can't hear him anymore. So I'm sorry for that. Lars, can you hear us? Maybe type something in the chat.
okay. Am I back?
Ah, now you're back, Lars. I can hear you again.
Sorry about that. I got muted by GoToWebinar. I apologize for that.
So we lost you when you've been talking about the standards here presented on the
Okay.
on the screen. Yeah.
Okay, I'm not sure what you heard from me or not, so I'll try to be brief and not repeat myself too much. Left-hand side would be an upcoming ISO standard on a security reference model for hardware wallets, and on the right-hand side would be also an upcoming security guideline from the German Federal Office for Information Security. And I think the bottom line of this slide is that there's a lot of work on standardizing security aspects. For example, mandatory use of secure elements, and then what kind of properties those secure elements need to have and what properties the protocols need to have that are implemented on top of them. But I can tell you, for example, there's no specification of the actual payment protocol in there. So we will probably see a bunch of different payment protocols emerging depending on the country, depending on the use case. And I think it will take a while until we are in the same stage as card schemes, where a lot of things are standardized and they work in similar ways across the world. And I think this is already the last slide. So yeah, I'm thanking you for your attention, and I'm happy now to take any questions.
So thank you, Lars, for this pretty good overview of the journey we have in front of us from physical cash to digital cash. Gives a pretty good overview. We have some minutes left, and I therefore want to ask in the round: are there any questions to Lars? Okay, so obviously not. Then I would have one question here from the chat. So the talk mentions that EMV as a standard is not suitable for storing offline balances. Are there any parts of EMV or any other standards like PCI, PTS that are relevant for offline payments today that could be reused?
The answer is yes. There's a lot of parts that we can reuse. EMV is not a single standard. EMV is a set of different standards. Application selection, for example, is something that is very relevant, as I mentioned. So this can be reused for sure. In terms of like management procedures of the point of sales terminal, I think existing things can be reused. PCI PTS is also extremely relevant, of course, because it describes security aspects of the terminal itself. So it's not really so much about the protocols. The actual payment process is about like how like the security aspects of the device itself. So short answer is yes. I also mentioned global platform, of course. We are using the SCP standards for this end-to-end encrypted channels. So we're kind of not making up our own cryptography. That would not be reasonable. But yeah, so I can't give you an exhaustive list of standards that we could reuse, but I'm sure some standards can also be amended or extended with things that are specific to digital cash. But again, I think it's still too early to tell, what the overarching standard is going to look like. So for now, we're picking and choosing the stuff that works, and we're defining our own stuff as we go along. Hope that answers the question.
Yes. Thank you. Then there is another question in the chat. If the transaction fee is 0, what is the driven to deploy digital money?
Oh, that's a good one. That's a very good one. This is basically a question about the business model. Who's earning money from CBDC payments? And I mentioned transaction fee 0, but I should qualify that statement. The transaction fee is 0 from the perspective of the central bank. So the central bank is not charging money to issue the banknotes to customers. So this is the same as for the digital cash, right? So I can hold the banknote free of charge, basically, and I can get the banknote, and the central bank will not charge money for it, but my bank might charge money for it because my bank offers some services related to that. They are offering support. They have to do the KYC checking and all of these things. So there might be fees that are between the intermediaries and the fees that are between the intermediary and the merchant or so on. So if you're interested in that, the ECB has recently done a deep dive on that, and they're also talking about interchange fees, for example, for the digital euro. So that would be comparable to the existing card schemes. So the transaction fee, again, is 0 between the central bank and the end users, but there's many more moving parts in that ecosystem. So the business models still exist. But I think this talk is too short, and also I'm not the expert on these kind of economical questions. So yeah, I can only refer you to the European Central Bank. If you browse around the digital euro website, you will find some information on the business models that they're thinking of.
Okay, thank you, Lars. There is another question in the chat. If there is no standardization at the moment, can we say CBDC will not be interoperable in the near future? Each CBDC scheme will work independently, right?
For now, probably yes, but it also depends on how you define interoperability. Right now, the different national payment infrastructures, so the RTGS and all of these systems, all of the instant payment systems in different countries, they also work separately from each other. So they are not interconnected in any way. Yet I can still transfer money from one country to another country. So you need intermediaries that sort of translate between those systems. If I want to pay money to a bank in UK, then my bank will need to talk to that British bank and somehow exchange the one money for the other money. So this is something that we already do in the existing financial system. It has a lot of frictions, so it's not optimal. It still has a lot of fees. In particular, when you think about remittances, for example. So the remittances are notoriously high fee transactions. My point being that for now, I think you're technically right in the sense that the CBDC schemes will be separate. But my argument is kind of twofold. First argument is that existing landscape can already deal with that, and it's still interoperable to some extent. And the second point is, of course, this is only talking about now in the near future, and I'm hoping that there will be more efforts to make that more frictionless in the future.
Okay. Thank you. Then we have another one, a blockchain. Blockchain is a good option to be used here.
That's a very good question. I removed the slide about blockchain from this presentation because I thought it wouldn't come up, but now it's coming up. Yes and no. So there is some consideration of using blockchain for CBDC in some central banks, but they're more talking about blockchain in the context of wholesale operations. So basically in terms of interbank settlement. In terms of retail, so in terms of actually end user operations, so basically what this entire talk was about, the answer is pretty much no. If you look at the ECB, if you look at the Bank of England, if you look at many other central banks, they don't want to use blockchain for that for many reasons. One reason is that the performance is just not great. If you want to run a domestic payment scheme, you want to have tens of thousands of transactions per second. And also the other thing is, it's very hard to do these kind of things on a secure element. So on a secure element, you're really, really constrained in terms of what logic you can do, what kind of crypto operations you can do. So there, traditional database-based approaches would do the trick just as well.
Okay, thank you. Then another question here. If my card with the wallet gets stolen, is it possible to cancel it? For example, by a request to my bank or to CBDC?
No, not really, because it's like cash. You can't cancel cash once it gets stolen. Um, so this is why I also talked a little bit about privacy and anonymity in this presentation. If it were possible to kind of recall the money from a lost wallet, then it would mean that someone knows how much money you have and at what point in time you had that money. And that's just not desirable for something that resembles cash, right? So for cash, this is not possible because you don't know. And the other complication is, of course, if you're making offline payments. If you're paying to your friend and you're both in the Bavarian mountains and both of you are offline, who knows? No one knows how much money you had at that precise moment in time. So if you were able to somehow restore the balance or cancel the balance, you might be canceling too much money or not enough money. So it's really difficult to do that in a general way. Having said that, there could be business models in terms of insurance, for example. There could be an insurance that queries your wallet every day and then charges you some kind of premium for that, and then they could reimburse you. But it would be a reimbursement. It would not be like the actual original tokens because you never know where they are if they're circulating offline.
Okay. And then here we have another interesting question. Is digital money has anonymity? So is it anonymous?
Yes, yes. I mean, that's basically also relevant to the previous question, I guess. The answer is yes, we are looking here at cash-like privacy. But there are some qualifications to that statement. For example, consider like let's say you want to do money laundering. Let's say you want to launder money. Let's say you have 1 million euro and you want to move it somehow. In cash, that's really inconvenient because you have 1 million euro with you, and it takes space and everything, and it's just inconvenient to handle that much cash. Um, if you could have 10 million euro on a smart card, would be much easier to handle. I mean, it hardly takes any space, and it's just a number after all. So most central banks, if not all central banks, do not want that to happen. So they don't want people to be able to move around large amounts of CBDC without them noticing, because if you make an offline payment, no one's observing that payment. So this is why central banks kind of have to square the circle. They want anonymity, but they also want to prevent money laundering and these sort of things. So this is why they have kind of settled on a concept where you have limits, not technical limits, but kind of regulatory limits of what you can do with wallets. There are no clear numbers yet, so everything I tell you is like preliminary. The ECB, for example, says you should have at most 3,000 euro in your wallet, and maybe even offline you're supposed to have even less, maybe only 1,000 euro in your wallet. Maybe you can only do payments up to 100 or 200 euros a day. Maybe you can only have the money offline for a week, and then you need to go online again. You need to kind of reshuffle. So these are all different ways of controlling for these problems with money laundering without sacrificing anonymity, because all of those limits would be enforced through the wallet, through the secure element. And since we trust the secure element to do this correctly, this is a satisfactory solution for the central bank. So this is how they're trying to sort of square the circle on that. That notwithstanding, there could also be other options. So for example, the central bank could say, we don't care, you can make payments as large as you like, but then they can't work offline. So you can pay 1 million euro, maybe not, but let's say 1,000 euro, but then you can only make that payment online, and it's going to trigger some checks by your intermediary. So there's various options on how this could be achieved.
Okay, thank you, Lars. I think we have reached the end of the session. So we are 1 minute to 10. And therefore, I want to close the session right now. Thanks a lot, Lars, for your presentation and for answering all the questions. I can say there are even more questions coming. Maybe we can also comment then later on the website or YouTube channel things that have been open. Thanks a lot
Or send me an
for
email. Send me an email. I'm
yeah.
happy to also answer there.
Thank you, Lars. So, and yeah, we have a second session later today, 5 o'clock Central European time. For the ones that could not listen to the full presentation, there's still time that yeah, you can listen in the afternoon session. Thank you and have a nice day. Goodbye.
Thank you.